In today's video, we're going to be talking about one of the most powerful financial tools available to Canadians. That's the tax-free savings account, or TFSA. So if you're interested in seeing your money grow quite quickly and tax-free, stick around to the end because I'm going to share some pointers about how to use the TFSA. All right, the entire account's sitting at $155,905. It's comprised of 4 separate accounts: my cash account, my kids' RESP, my RRSP, and my tax-free savings account, which is the start of the show and the reason that I started my channel. You're gonna watch me build it from zero to maxing this out. The cash account's sitting at $20,139, and it's earned $59 in interest this month. Now, the interest rate on this account sits at 4.25%. Now, that sounds pretty juicy, but if you know, the Bank of Canada actually slashed rates yesterday, so that actually creates a downturn for accounts like this one. And so I got this email here where Wealthsimple is telling me that as of October the 28th, they're going to be slashing the rate from 4.25% to 3.75%. But that's not all doom and gloom, because you need to have an emergency fund. If you're just starting out, guys, I really suggest that you get an emergency fund set up. You never know when something bad is going to happen. Like, for instance, you might lose your job, or maybe you didn't get a high enough paycheck one week because perhaps you're not full-time and you're not working a lot of hours. You want to be prepared for that. So that's why I have that account set up. Into the kids' RESP, it's sitting at $74,494, and by the time the kids are 18, they'll have $421,000, which is absolutely fantastic. You know, we're getting them ready for that time. Don't make the same mistake I did and wait too long to start an account like that. Net deposit $60,259. The returns on the account $14,234, which is 23%. When we look at the activity tracker, we can see that we had a reoccurring investment. That's $100 for each kid. We're trying to max out the contribution room in there. We invested in ZFL, ZEA, and QCN. And then followed by that, we had our next reoccurring payment of $100 for each kid, and that was invested into ZEA. All right, jumping over into the RRSP. For the last day, it's at $18,752, down $32 on the day. Over the last week, it's down $44. The markets have been pretty volatile lately, so lots of ups and downswings. $529 on the month we're up. Over the last 3 months, we're up $884. Over the last year, this account is up $4,341. All-time return sitting at $3,556. And I've only been at this for about 18 months. We only have 11 cents sitting in this account. Here is a snapshot of what's in this account. Now, the reason there's only 11 cents is because I don't actually invest in this account. I'm taking advantage of that tax-free savings account because your money will grow tax-free in there. One of the big benefits, and we'll talk more about them in a little bit. In my RRSP, I have a mix of US and Canadian funds. It's taken me a bit from when I started investing. I basically had Canadian stuff and then moved it over. You can see VOO, that's the biggest position in this account, and it's held in there because it doesn't get the dividend taxed because it's in an RRSP. All right, the tax-free savings account, $42,186. It's down $97 on the day. Over the last week, it's up $30.47. Over the last month, it's up $1,038. Over the last 3 months, it's up $2,306. That's in 1 month of growth. In the last year, it's up $6,957. And all-time returns were sitting at $6,483. Okay, guys, if you're just starting out, it's really important to set yourself up for success, and that's with consistency. So the first thing you really need to do is pick a broker. Obviously, you want to find one that works well for you. In my case, I use Wealthsimple. If you want to get started with Wealthsimple, look in the description below. You can use my link and you'll get $25 right off the hop to start investing with. But you want to establish good patterns. What I mean by that, consistent patterns means, do you invest once a day, once a month, once a week, or every 2 weeks? Whatever it is that will make it work for yourself. You don't have to do it the way that I'm doing it right now. You can start off with any amount. Pick an amount, pick your stocks, and be consistent with that every time you go to invest, whether, like I said, it's every day or every week or whatever the case may be. You're going to see that compound. Look at my account. My account has grown a lot, and I've only been at this 18 months. And remember, this is in the TFSA, so it's growing tax-free. And we'll talk more about that in just a minute. All right, so we have $2.57 sitting in our stock lending. So in Wealthsimple, you can turn on stock lending and we'll loan your stocks out to other people to use. They are doing a different strategy than I do, but I can benefit from it. So the next payday on there is November 14th, and we can see that we have Plaza REIT that's on loan. All right, let's go over the account. So we have BAM, Brookfield Asset Management in there. We have Canadian National Railway, HYLD, which is a covered call. We have Plaza REIT. We have QQC, which is the NASDAQ 100, REI, TELUS, TD, VFV, that's the S&P 500. And of course, we have VRE giving us broad exposure to REITs, XEC, XEF, XEI, which is that high yield dividend fund giving us monthly distributions, and finally XIC. In the activity tracker, we can see since the last video, Plaza REIT paid out its dividend. Then we had stock lending pay us out our earnings for loaning those stocks out. Plaza REIT was then dividend reinvested because we have DRIP set up back into that. We're slowly growing that Plaza REIT position. I'm getting it to the point where hopefully we'll be adding a new stock every month with the DRIP because it is enough to buy one stock. You can see here that I was having money dropped into the account like $1 at a time. The reason for that is if you've watched some of my past videos and know that there was a bit of a glitch with passive and I've been waiting for them to rectify. Well, I finally can say that they fixed it, so that's great. And if you don't know what passive is, it's the tool that I use to do a lot of my tracking, and we're going to look at that in just a second. So I'm glad that they fixed that for us so that I can actually have all my dividends tracked and share that information with you guys. All right, so over into passive, our asset allocation is sitting at 95% accuracy. You can see we only have $2.57 in cash in there. The account's sitting at $42,180. And of course, like I do every 2 weeks, is I'm going to drop my $1,000 in there to invest with. So we're going to go ahead with the magic of editing. There's our $1,000 dropped in. Drops our asset allocation down a little bit to 93%, but when we buy our stocks, it'll go back up. So we're using it to help us figure out what to buy. It'll be CNR at one stock. We're going to buy 2 shares of QQC, which is the NASDAQ 100. We're going to buy 1 share of REI or RioCan, which is a REIT. We're going to buy 7 shares of VRE, giving us that broad exposure to a whole bunch of REITs. We're going to buy XEC. Now, what's XEC? XEC is emerging markets. It's an ETF by iShares. And the nice thing about this is it gives us broad exposure to 1,500 stocks from around the world in emerging markets like China, India, Taiwan, Korea, Brazil, and so on and so forth. All right, and the last thing it's telling us to buy is 8 shares of XEF. What's XEF? Well, XEF is an iShares ETF, and it gives us broad exposure to 1,500 stocks around Europe, Asia, and Australia. And when we look at the geography on this, we can see we're investing in Japan, the United Kingdom, France, Switzerland, and Germany, Australia, and so on and so forth. All right, so after I bought all the stocks, I had a little bit of money left over, but I noticed something recently when I was looking at Passive. Passive has some great tools in it that allows us to look at metrics, and I noticed there was quite a dip in the markets. It's been that way for the last little while, and I don't profess to take advantage of the sort of dip, buy the dip as they call it, but in this case, I wanted to examine my accounts to see, is there a little bit more money that we could throw in there? And I managed to find a little bit more. It equates to $52. Now, for me, what that looks like is I just have to make a sacrifice with something in order to invest that money now. So I take my lunch to work. I don't go to work and buy my lunch, but if you look at the amount that I invested, that probably equates to buying lunch once a day for your work week. So if you take your lunch, you can then invest that money instead and watch it compound because it's going to grow. All right, so it's suggesting that we buy 1 share of Plaza REIT and 1 share of QQC. Now, this is not, QQC doesn't fall in line with my methodology or thought of today. As you know, the Bank of Canada slashed rates yesterday, and so that's going to have an impact on mortgages, which affects, I believe, companies such as REITs. And Plaza REIT and RioCan are 2 of the ones that I hold. So I'm going to step outside of passive today. I'm going to take its recommendation for Plaza REIT because it's one of the things I want to invest in, but I'm not going to use it for QQC. I'm actually going to go ahead and invest that money into RioCan. All right, so we're going to go back into Wealthsimple and we're going to buy a couple of shares of RioCan. Now, RioCan is a commercial real estate company in Canada. It has a lot of properties throughout the country. The nice thing about RioCan or REITs is they give you monthly distributions. So if it's something you're looking for to see monthly distributions, which you can take advantage in your TFSA, which we'll talk about in a minute, then this would be probably a good position to consider or something similar to it. We're also going to buy 3 shares of Plaza REIT. Again, it's a REIT with monthly distributions. We're growing that position. I'm about 65% of the way to a full drip where I can get a single stock every single month. So we're working towards that, and I can't wait till we get there. Okay, so let's talk about TFSAs and how great they are. But before we do that, we really need to know how much room we actually have in our TFSA. And we can do that with a simple Google search. So we're going to jump over to Google. You're going to type in TFSA Contribution Room Calculator, and you're going to get quite a few returns. The ones that I like to use, or the one that I like to use commonly, is with Rate Hub. So we're going to click on that. And then what we're going to have to do is answer a few questions. So were you a resident of Canada before 2010? Well, I was, so we hit yes. The next thing it asks us is, what year were you born? So I'm actually going to make that up. I'm not going to tell you guys how old I really am, because I'm old, So we're going to say we were born in 1980. And then from that, it's going to ask us how much money we've contributed to our TFSA. In my case right now, you guys know my account's sitting around $43,000, so we'll use that one. And then it says, have you ever made any withdrawals from this account? Well, I haven't, so we'll say no, but if you did, you should say yes. So we'll say no, and then it's going to calculate out how much room we have. And you can see here we have room, $52,000 left for room in this account. If you're looking for a bit more accurate way in order to figure out how much contribution room you have in your TFSA, you can actually go to the CRA's website and you can check out how much room you have, and it's based on last year's tax return, which to me is much more accurate, because one of the downsides, as I mentioned, is if you over contribute to your TFSA, you're going to wind up getting taxed on that. So it's really important to know exactly how much room you have. So let's jump into mine and we'll see how much room is left in mine. Now this sign-in process is pretty simplistic, using an external bank, which makes it very secure. So all the steps that you would use to sign into your regular bank account are used here, and that's obviously to avoid somebody breaking into your CRA account and using your information and conducting fraud. All right, so I've skipped through all the steps. I've signed into the CRA, and this is the part of the page that you want to focus on right here. This is going to tell you exactly how much room you have for each account. So in my RRSP, I have $98,977. It's very accurate based on last year's tax return. Of course, it doesn't account for anything that's contributed since the last tax return until now. And the home buyer's plan, we don't owe any money because we haven't used that right now. And of course, the one we're looking at is the TFSA. We've got $83,584. And of course, you can see the little icon there that says warning. So that's where that calculator is going to come in handy, because whatever contributions you made since your last tax return, you would want to subtract that so you know exactly how much room you have left. Like I said in the beginning of the video, we're going to talk about all the benefits of TFSAs and why they're so great. And of course, the one that jumps right out to mine off the hop is the fact that they're very diverse accounts. You can either use them as a savings account, or in my case, you can use it as an investing account. And the reason I started my channel was to share all the mistakes I made, and this was definitely one that I missed out on. We had used our tax-free savings accounts for so long with simple interest earning accounts, earning, sometimes 2% or less. But now that I've been investing, if you saw how much gains I've had in my account, you can see how important it is to use this room. And you can invest in just about anything in here: bonds, in stocks, in mutual funds, or in ETFs like I'm doing. So the second thing that's really great about tax-free savings account is exactly how it sounds. When you put money in and invest, it grows tax-free, unlike an RRSP. When you invest your money in an RRSP, you're getting the tax benefit now, but of course when you withdraw that money later in life, you're going to get taxed on it then. So that's why I would suggest starting off with your tax-free savings account first. Max that tax-free savings account out as far as contributions go, and I showed you how to figure that out, and that money will continue to grow, and all that growth in there is tax-free. Something that's really important to know about the tax-free savings account is that you don't lose the room unless you withdraw the money. So this is also one of the benefits of the tax-free savings account, but something to pay attention to. So let's assume that you wanted to invest some money because you had some money kicking around. It's outside of your emergency fund and you wanted to see it grow more than say 2%, so you invest it. Maybe you follow a covered call strategy where you're getting big monthly dividend returns and you want to use that money. Some people will actually live off it. So the trick here is that let's say you withdraw $5,000 from your TFSA this year. You can't use that room until next year. But again, it's a benefit of using a tax-free savings account because when you draw that money out, you're not being taxed on it. And then in the following year, you can use that room again. All right, so the beauty of the TFSA is it continues to grow over time when the government decides to add more contribution room to this account. So annually, you'll see an increase in that. So TFSA room is not tied to your income. It's actually all the same for every Canadian. And here is a chart from the Bank of Canada website that tells you exactly how much money that is. So from 2009 to 2012, the limit was $5,000. From 2013 to 2014, it was $5,500. And you can see that it just steadily grew to 2024 when it was $7,000. So now we just have to wait. If you've maxed that account out, you just have to wait till next year to see how much more room there may be. All right, so we've learned lots of stuff about the TFSA, but there's one thing that most people overlook and don't even think about. You actually have twice the amount of room. And where does that come from? It comes from your spouse's TFSA. So once I've maxed out my TFSA, I should really be looking at maxing out my wife's TFSA or my spouse's TFSA because you actually have double the room. Now imagine the amount I just showed you doubling in size over a long period of time, but then doubled because we have actually two accounts to work with. Now, if you're looking for a lot more information on investing, Blossom Social is the best place to do that, and you can learn more about it by watching this video right here.